Good evening, all. We'll wait for 2 minutes so others can join. Okay, then we will start. So, are you guys see my screen? Is the PPT is clearly visible to you guys? Please confirm, then we will start.
Yes, sir.
Is it okay?
Yes,
Yes,
sir.
sir.
Okay, thank you. So, in first chapter of the subject international finance, we learn the basic definition of international finance. Okay, we also learn the different participants. Okay, the we can say different uh, international bodies, national bodies who participates and who makes the international financial systems that we see in the last sessions. We also see the we can say the different uh, types or the we can say the system to which we called as the international finance. We called the across border trades. We called as the foreign transaction, foreign we can say the monetary transactions. We also called the capital flow in across the borders. So all these things we can say the comes into the definition of the subject of international finance. Okay, we also learn the different international bodies, like we learned in the last sessions yesterday. We learn how the IMF works, when the IMF established, how World Bank work. Okay, what are the objectives of the IMF? What are the objectives of the World Bank? Okay, and we also learn the we can say how the central banks of the different nations uh, have their role in the international business and the international trade, international finance. Okay, so that we also learn, and we also learn that the US is, we can say, the dominant economy from last 75 years. That we also discussed yesterday, we discussed yesterday that US is the dominant economy in the world, that every nation accepted the payment of the uh, trades on the international level. Okay, so that we learn, and so that's why, and because of the dominance of the trade, that we required the exchange rate. Okay, we also learned in the last session that is the how the we can say the for currency exchange system changes over a period of time. As we learn in the we can say the early 19th century, there is a we can say the closed standard system. That means the many of the nations. We can say most of the nations make their international payments in gold. Okay, when there is we can say the currency is invented and the paper currency came into existence, the every central bank of every nation starts printing a currency notes. And now the nations don't have the enough gold reserve to make their payments. Okay, to make the payments for the foreign trades. Okay, now the we can say the countries wants to make the payments in the currencies. So at that time we know that there is the fixed currency exchange rate. We can say regime at that time they decided that $35 is equal to the 1 ounce of gold. And according to that, the other countries convert their currency into gold. That means they buy the gold with their currency and then they convert that gold into the dollar and then they will make the payments. But in 1971, we and the fixed exchange rate systems collapse and the floating exchange rate starts onwards. Because what the US thinks that their currency is dominance at the world economy, and that's why they want the floating exchange rate. So they'll get the maximum benefits because they know when the floating exchange rates came into existence, the value of their dollar at the world level is drastically increases. Okay, so that's we learn in the last two sessions. Okay, we understand thoroughly what is the international finance foundations. Okay, so in this subject, we are going to understand what is the foreign exchange market. Whenever there is the exchange of the goods and services across the border. Okay, whenever that means whenever we import the oils, whenever whenever we can say export the we can say the different grains, masalas. So how we make a payments and how we receive the payments. That is the how the foreign exchange market works. That we are going to discuss in this session in this and what are the different participants in the foreign exchange markets? How the currency exchange rate decides? Okay, so all these things that we are going to discuss in this sessions. Okay, how the parties actually make the payment for the international trades that we are going to discuss in this chapter. That is, we can say the global exchange market. Mm, so the global exchange market actually acquire the whole world. That means near about the 190 members that the each country who are doing the trade on the international level. Now it is the part of the foreign exchange market. Okay. So the foreign exchange market forms the it is actually the backbone of the we can say global trade, global commerce. Okay, that facilitate and we are know that without the payment system, if there is no payment system at the international level, the no trades will happen. Okay, because we know that whenever there is the exchange of the goods and services, there has to be exchange of some valuables of the same value. Okay, we know that when there is the no currency, no gold, no diamonds were present, there is a barter system. Okay, we exchange the goods with the goods, service with the service. Okay, same likewise nowadays we exchange the goods and services with some value of currency. If there is the no exchange mechanism were present on the international level, it is not possible to make the international trade. That means the we can say the exchange we can say the payment systems is one of the most important part of the international trade. Okay, so that enables the international trade and the investment by facilitating the exchange of the currency. Okay, so that foreign exchange markets actually helps to, we can say, the exchange of the currencies and the investment across border investments they're helping. So in this chapter we will explore all these things, that is the scope of the foreign exchange market, the different participants, and the structure of it's the massive marketplace, because we know the foreign exchange markets is a huge market because it consists of near about 99% of the world, because the each and every country is doing the trade at the international level. Because they are incapable to fulfill their requirement in their, we can say, own nations. Okay, every country wants something from the other nations. Okay, as the, we can say, the countries like the Middle East, Arab countries which are having the less rains, those countries require the grains, those countries require the fruits, and those countries having the, we can say, the abundance of oil. So they export the oil they are having to the other countries to fulfill the energy requirements of the other countries. So it is, we can say, the every nation is dependent on some other nation for some of the requirements, and that's why, because of this interdependency, the international trades happen. Okay. So we can say nearly about the 99%, the whole world is the part of the financial system. Now, if you understand the what are the transactions value, okay, so here are some of the numbers, the recent numbers we discussed. That is the, we can say, the largest financial market in the world is the, we can say, the foreign exchange market. Okay, so near about the 7.5 trillions of value is daily, we can say, transact in the foreign exchange market. So it is the huge number. I think so. It is the number is more than the Indian economy. Okay, so that daily transactions are happen daily on the international level. Okay, so it's a very huge number. So daily trade, we can say, it is the number which is the traded daily as of the 2050, exceeding the combined volume of the all stock markets worldwide. So the number is a very huge. Okay, it is more than the number of the combined value of the all stock exchanges in the world. Okay, so, and we can say near about, we can say, the near about all the economies of the world except US. Okay, so the US market. So what is the working hours in the foreign exchange market? As we know that some of the nations having the, we can say, every nation has the different working hours because of the rise uh, 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 of the sun, and we can say, so the day timing of the every nation is different. So the foreign exchange markets keep working by 24 by 5, not 24 by 7. That means the foreign exchange markets are closed on the Saturdays and Sunday. So we can say for the 5 days, that is Monday, Tuesday, Wednesday, Thursday, and Friday. Okay, this for this 5 days, the foreign exchange markets, the 24 by 5, that market is, we can say, a very active. That is the continuous trading across the global financial centers from Sydney to New York, from Delhi to, we can say, uh, Japanese market, Chinese. So in all these, we can say one of the centers, like the, we can say, uh, uh, the foreign exchange markets active, we can say, in nights and days for all the 5 days. So what when these foreign exchange markets make the payment, so what is the, we can say, nature of the payment? In which currency they are doing their payments? So what we are found, that is the 87%, we actually these things learned in the previous uh, sessions in the previous lectures also, the US economy is a very dominant economy in the world because of their development, because of the uh, we can say the demand of the US dollar at the international level, because the most of the nation accept the US as a payment, because US is, we can say, a rich country, which is the country having we can say a huge natural resources, and so that's why the US dominates the market. So 87% of the international trades and the international payments, we can say, are happened in the US dollar. That is the we can say the percentage of transaction involved in the US dollar as one of the side of the currency pair. So what we found that the US is the now currently is the US is the dominance in the market. So whatever will be happened in the futures, okay, if the China, India, we can say compete with the US, then we can say the scenario may change. But in the current scenario, that is the 87% of the foreign exchange payments are happen in the US dollars. Okay, now the who participant in the forex market? Okay, who are the participant in the foreign exchange market? Okay, so first one is the banks and the finance. We can say first we understand the central bank and the government guide, and then we understand the banks and the financial institutions. So the central banks and the governments, who we can say who are the policy makers, rule makers for the foreign. Uh, exchange, we can say the foreign payments. That's the FX market. Okay, so as we know that the government who makes the policy for the international trades, who make the policy for the foreign direct investments, okay, who makes the policy for the foreign payments also, and the central bank who authorize or who approves the other commercial banks and who made the rules for the international payments. So that the central bank and the government influence the, because some of the times if the government feels that the value of their currency is less on the international markets, what government do? Government can take some steps to, we can say, to strengthen their uh, currency. Uh, we can say in front of the US dollar. Okay, so at that time also the government plays the very crucial role in the forex market. Okay, so bank and the financial institutions, we can say the some of the major banks forms the interbank market where the massive volumes are traded. Okay, so the some of the commercial banks who helps for the foreign payments. So these banks also plays, we can say the some of the banks, like we can say the some of the nationalized bank in India like SBI, Punjab National Bank, okay, Central Bank of India, some of the private banks, the banks like HDFC, Axis Bank. So all these banks get the approvals from RBI, and only these banks are eligible to make the foreign payments. Now, some of the financial institutions, we can say the uh, reach those banks having we can say a huge amount of capital. These banks also invest in the other countries. So so at that point of time, so these banks is plays the important role because of they we can say uh, these investment banks helps the businesses for the currency exchanges. Okay, now next one is, we can say, the uh, who is doing the business on the international level. That is the multinational companies or the multinational corporations. So it is one of the main participants in the, we can say, the foreign exchange market. That is the companies who are actually doing the business on the international level. Okay, that multinational company exchange the currencies for international trades. Okay, for their international investments, because they produce the goods and services in one nations, and then they send to the other nations. So while doing this, they want the currency exchange. Okay, so multinational companies and corporations who is actually wants to convert the currency into the other one nation's currency into the other nation's currency, and they do it with the help of the banks and the financial institutions. And who approved that bank and financial institutions? That is, we can say the central bank of each nations and the government of the each country who plays the roles in the approvals. So they can say the corporations who actually wants the foreign exchange the currency. Now next one is we can say the investors and the traders. So the investors and traders who are doing the investments, you can say across the border investments, that are also the participants in the foreign exchange market because they are doing the investment across the border. That is, we can say the cross border investment. Yeah, if I am having we can say 100 CR, but I cannot invest if I want to invest that my 100 crore rupees into the any of the foreign currency. For example, I want to invest my amount into Russia. But first, what I need to do, I need to convert my 100 crore rupees into the Russian currency, and then I can invest the same amount with the Russian country. Okay, so uh, that's why the investors want to convert the currency, and that's why he then whenever he wants to convert the currency, he goes to the financial institutions. The financial institutions helps the different investors and the traders to exchange his or her currency. Now next one is we can say what is the structure of the foreign exchange market. Okay, so first we understand uh, the foreign exchange market, how it works. Okay, what it structures. Okay, so first if you understand, it is the decentralized structure. And why it is the decentralized structure? Because the no central agency or the physical locations. Okay, we cannot found it, we cannot say it is the headquarter of the foreign exchange market. Because we know the every central bank plays the crucial role, every government is play the crucial role. So all these are the regulators of the foreign exchange market. Okay, there is no single regulator. There is no single headquarter of the foreign exchange market. If you say if we in any one nation's case, if you say India, in India, RBI is the central of every bank. Okay, it is the central regulatory authority of uh, the banking systems. That means the every bank has to follow the rules and regulations of the RBI. The banks cannot take the decisions on its own, but they have to follow the rules and regulation of RBI. But it is not in the case of foreign exchange market. There is no single regulator or there is no single headquarter of the foreign exchange market. We can say it is the decentralized market. That is the every central bank and the commercial bank of all the member countries are the, we can say, plays the crucial role in the foreign exchange market. So we can say it is the, we can say, the decentralized structure. Okay, because of the no central exchange office is there for the foreign exchange market. Okay, so it is we can say the foreign exchange market is nothing but it is the market is the consistent of the, we can say, the electronic networks of the bank, brokers, and the institution. That means you no need to uh, we can say make your payment physically. It is the electronically connected market. That means the one bank, whenever you want to exchange the currency, you will get the currency in the electronic form only. Okay, so no physical, we can say the no need to convert the currency into the physical form. You can convert your currency into the electronic form only, and you can directly make the payment within seconds to any nations. Okay, to the we can say party of the any nations. Okay, within seconds, and it's we can say because of these electronic devices. Okay, and because of the facilities like the internet. Okay, so the network is the consist of the all the electronic devices in the central banks, in the commercial banks, uh, uh, and it is the combination of all this. We can say the advanced technology. Now, next one is as I told you that the foreign exchange market is work for the 24 by 5. That means it is a continuous process for 5 days. Okay, so on weekdays, on Saturday and Sundays, the foreign exchange markets are closed. But on the 5 days of a week, it is the continuous process. That means at any point of time, if you want to convert your currency or the any organizations, any company, any trader, any investors want to convert his currency and want to invest, he wants to make the foreign payments. So the facility is available by 24 by 5. Okay, so we can say what are the market tires. Okay, so first we understand what are the different market tires in the foreign exchange market. First one is the interbank market, that is the wholesale trading between the major banks. So which are the banks? We can say some of the investment bank like Citibank, uh, JP Morgan, Bank of New York. So these are the banks who are doing the wholesale trading between them. Okay, so it is we called as the interbank market. Next one is the client market, and the banks serving the corporations and the institutions. Okay, whenever any individuals or the multinational companies wants to convert their currency into the other currencies, that we called as the client market. That means these banks provide the client services to their clients. That is the foreign exchange services. That is the conversion of the currency, or we can say, or the payment services at the international level. So that is the client market, and we can say for last one is the retail market. That is the brokers providing the access to individual traders. Okay, so there are some of the brokers who works on the international level. They provide their services to the individuals. Okay, so that's we called as the retail market. So it is the structure of the foreign exchange market. Now we understand what are the types of the forex, that is the forex transactions and the settlement dates. Okay, up to that time, we understand how the foreign trades happen, why the foreign trades happen, and to settle that trade. Okay, uh, what is the time required, how the payments are settled, that we understand. We know that whenever if we buy something from any of the nations, we will have to make the payment. Okay, so in that part we are going to understand the settlement date, how these forex transactions happen, in how much time they settle. Okay, that means if I receive something from the foreign, in how much day I will make the payment. So what are the different types? What are the different transactions which are available at the international level, that we are going to understand? Okay, so we understand that with the very simple example. If you want to buy something, you have the two three options. Okay, uh, if you want to buy a pen, you can directly goes to the shopkeeper. You give the in rupees to that shopkeeper, and you can buy the pen. So that is the spot transaction. That means everything, that is the transactions, all the exchange of the goods and the monetary value, that is the currency, that is the spot. On the spot, we can say the exchange are happened, and that's why we called it as the spot transactions. Okay, so that is one of the uh, options every customers have. Or I can say if the shopkeeper is we can say know me very well, so I there is one other options to me, that I will buy a pen and I tell the shopkeeper that I will make you the payment after the 11 days or the 12 days, 15 days. Okay, so that means we make the payment after some time. That means it is the, we can say the, that it is the forward transactions. That means on the spot we only exchange the pen, but if we not we can say the transactions of the monetary value is pending. So that will happen after the 15 days. So that we called it as the forward transactions. So in the same way, the trades on the international levels were happen. Okay, so that's we called as the derivatives. Actually, the what is meant by the derivatives? So derivatives is a contract between the two parties who are doing the trades. Okay, and its value is derived from, we can say, some other entity. So entity, it may be the anything, it may be, we can say, whatever we are going to trade. That is the, we can say, the agricultural product, or it may be, we can say, the valuables like the gold, silvers. Okay, it may be the energy exports. Okay, so for that across the border trades, the derivatives contracts, we can say, uh, done between the two parties. So there are, we can say, the four type of derivatives contract. Okay, four type of transactions in the derivatives contract. The first I actually told you, that is the spot transaction. Next one is the forward transaction. Now third one, that is the first one is, that is, we can say, the forward contract. And next one is the future contract. Third one is, we can say, the options contract. And fourth one is the swaps contracts. So all these derivatives contract used at the international in the international market to hedge the risk, to reduce the risk. Okay, we know while making the payments on the international level, the main risk associated with the payment is the exchange rate. That means if you buy something after the 6 month, it may be a case that after the 6 month the dollar value will increase. We know that we continuously import some goods and services that we are required. Okay, but we know that because of some parameters, that the dollar's value may increase after the 6 months. So it is the risk in the international finance that you will have to make the huge payment after the 6 months. So in by doing these derivative contracts, what the governments or the companies, the individual traders, or we can say the investors, they hedge the risk. That means they minimize the risk by doing these derivative contracts. Okay. So in this, we can say, sections, we understand the different forex transactions and their settlement dates. So the foreign exchange transactions come in a various format to serve the different needs, from the intermediate exchange to the complex derivatives for managing the future risks. Okay, that we already understand. Now, first transactions we see at the international level is the spot transactions. Okay, so spot transaction example that I already given to you, that you goes to the shopkeeper, you give the 10 rupees and you buy the pen. So when the uh, same trade or transactions, we can say, we see on the international level, the transaction we called as the spot transactions. That means we very quickly the goods and we can say the monetary value, that is the payments are happened. That is the the time required to settle the trade is the, we can say the standard T+2 settlement. That means if today we can say is the Saturday. That means today if you buy something from the foreign, so T+2. That means today plus on, so on Monday the payments settlements will be done. Okay, but actually on Saturdays and Sunday the foreign exchange markets are closed. But we just consider the example. If on Monday I receive the any goods and services from the foreign, then on Wednesday, that is the T+2. On Wednesday, the trades will be settled. Okay, so that is the we can say the spot transactions. Okay, so the spot transactions we can say reflects the currency market exchange rate. So whatever it be the uh, currency exchange rate at that point of time, with that same currency exchange rates, we can say the payments are done. Okay, the transactions are happened with the same exchange rate, and it is we can say the most liquid segment of the forex market. So it is the most liquid segment because the goods and service exchange goes with the we can say the with the payments, with the monetary exchange as well. And so because of it we called it as the most liquid. That means the cash and money is available in such a type of transactions. There is the we can say the no credit sales, and we can say sales and purchases in the spot transactions. Okay, so if you take here the one real world example is given that the if the American company needs the 5 million to pay a German supplier, that means the American company buys something we can say a value of goods of 5 million, and then now they has the financial obligation, they have to pay that 5 million to the German supplier. So what they do, they execute the spot transactions to convert their so then what the American companies will do, they convert their 5.4 million to euros because they, we can say German is a part of the European Union, and euro is their one of the currency that is the common currency of the European Union. So the American company first convert the 5.4 million to euros at the here is the currency exchange rate at that time when the we can say the trades happened at that point of time. What is the currency exchange rate is the euro is equal to 1.0 USD dollar. Okay, so on that exchange rate they we can say they do the currency exchange rate, and then the fund deliver in the 2 business days. Okay, in T plus 2 business days, the trade settles. Okay, the settlements are done. Once the exchange of goods and services, that is the delivery of goods, and the payment settles, then we call it the trade is, we can say, wholly settled. Okay, so the first transactions represent the foundation of the forex market, providing the price discovery for all the other transaction types. Actually, on the basis of the spot transactions, the value of the currency exchange rate, we will see how the forward transactions values were calculated, are calculated. So on that spot transactions value, actually the forward transactions value are determined. That we are going to understand. Now, what is mean by the forward contracts? Okay, locking in the that also we called as forward contract, as we can say same as the futures contract. Okay, so forward contract is actually that means the goods and services delivered. Uh, we can say the today, but we make the payment in the future. Okay, so the time of the payment decided mutually by the two parties who are doing the trade. Okay, uh, that means if one of the businessmen is from India and one of the businessmen is from US, America, so they mutually decides the time of the payment. Okay, so they decides that the America will deliver some goods, some we can say, for example, the iPhone to that businessman who is having his shops of the iPhone. Okay, and after the 6 months, he'll make the payment. So it is the mutual understanding between the two parties. Okay, so how the prices, we can say how the payment where are determined in the forward contracts. The forward contracts is nothing but what are the key features first we understand, and and then we understand that is who we can say the primarily. use this forward contract. First features is the pre agreed exchange rate of the future settlement. That means both the parties sit together, they discuss on mail, they discuss on phone calls, they discuss, we can say, in front of them, in front of each other, and then they decide the settlement date. Okay, they decide on which date they exchange the goods. Okay, they deliver the good, on which date they settle the payment. So it is, we can say, a mutual understanding between the two parties. We can say the customizable settlement dates, the 1 week to the several years. Okay, so they may decide from the 1 week to the several years. It depends upon their mutual understanding. They may decide that the payment will make after the 1 year, 2 years, 3 years. If the other party agrees, then we can say they mutually decides. Okay, so no one intervenes between the two party. Okay, so no upfront premium payment required. So basically, in forward contracts, the no party pays any premium to any other party. They only mutually understand each other, and they agree with the forward contract. Okay, so forward contract are actually the forward contract. Who uses the forward contract? Actually, we can say the, we can say, the different businessman, the investor, traders who want to minimize the risks, who want to minimize the risks with the foreign exchange rate, or those who are not having the payment, we can say, at the same point of time. They want some time for the foreign exchange to make the foreign payments. So those all the users uses these forward contracts. So we can say, what are the users of this forward contracts? Why the forward contracts is more beneficial as compared to the, we can say, the forward, we can say, the forward transactions as well. How this forward transactions is more beneficial than the spot transactions. First one is the hedging against the adverse currency movement. Okay, so when if we today, if the India import the oil from Russia, but we know that because of this, because of some geopolitical situations, that the value of the rupees get decreases because of the America puts the tariff of 50% on India. The things is not going well for the India. So in that case, but in forward contracts, the one benefit is that you can pre-decide the exchange rate. Okay, that that means whatever will be the exchange rate in the future, we are not going to pay with this. We uh, we pay with the exchange rate of the what decided in the agreement. Okay, what decided in the forward contract. So we can minimize the risk here. In spot transactions, we don't have that benefit. Okay, so whatever the exchange rate in front, okay, we have to convert the currency and we have to make the payments. But it is not in case of the forward one. In forward contracts, the pre-decided foreign exchange rates, the both the parties agrees with, and with the with that same you can foreign exchange rate, the payment will be done by the parties to one party to the other party. Now we can say next uses the, we can say, the budget certainly for the future international payments, because we know that the huge amounts are not are readily available to the organizations, to the investors, to the traders. So they take the advantage of the forward contracts. That means they can sometimes they delay the payments. Okay, for sometimes they delay the payments, that benefited them because they know that after the 4 months, after the 6 months, uh, they will have that much amount of money. Okay, so they adjust their payments. Okay, so these are some uses of the forward contracts. Actually, now next options which are available. Uh, for the we can say the businesses, that is the for forex swaps and forex options. Actually, options is the derivative contract in which we say that gives you the options but not the we can say the obligations to buy certain goods and services. uh, for example, if you take the example of the gold. First, we understand what is the for options contract, and then we understand that is the forex options. So, options contract is a derivative contract between the two parties who provides the options but not the obligations to buy goods and services. For example, if I have the gold shop, okay, and I know that in future that the gold prices are going to increase. So what I do, I do the forward contract with one of the suppliers, and that I I make up the options contract with them. Then in future that I will buy the gold on this price. That means if the today's price is, if we say the 8,000, and in the future it may goes to the 9,000. So I'll make the contract with the trader that I will buy the gold with the 8,200 rupees. Okay. If in the after the 6 month the prices of the gold will be increases to 9,000, so I will get the gold on the 8,200 only. Okay, that means I save 800 on each gram. Okay, so in such a way the options contract benefited. But if the prices of the gold, we can say my what I analyze, I wrongly analyze the prices of the gold reduced to the 7,500. Okay, now I make the contract of the 8,200, but in open market I get the gold on the 7,500. If I uh, if I buy this gold on the 8,200 rupees, not. I will buy in open market on the 7,500 rupees. So if I we can say in options contract that I have options that I can buy the gold in the open market. Okay, so we can say I can we can say have the options that I cannot buy from the other parties because I pay the option premium to the other party, to the suppliers. Okay, so those party who pays the option premium to the other party has the options to buy or to sell the goods and services. Okay, so that is the, we can say, the options contract. So that same thing will apply on the international level, that the businessmans do the options contract on the international level. Okay, so that's options contract we called as the forex options. That is, we can say, the international options contract. So the international options contract are, we can say, right, but so it gives you the right, but not the obligations to exchange the currencies at the predetermined rate. Okay, so the same options contract we can do with the currency exchange of the different with the different nations. That, for example, if I want to buy some dollars in futures, okay, so I know that today dollar is the 80 rupees. In futures, it may goes to the 85 rupees. So at that point of time, I do the options contract that I will buy after the 6 month on a 80 rupees with the same 80 rupees. But if in future the value of the dollar goes to the 85 rupees, then Uh, I will benefited by the 5 rupees on each dollar's purchase. But if the value of the dollar goes down to $75, then I'll buy the dollar in open market. Okay, I will not buy with the contract because in contract I receive the dollar on 80 rupees, but in open market I'll get on 75 rupees. So what is the use of the contract? So in option contract you use the option because you are the payee of the premium. Okay, who pays the premium to the other party will gets the benefit. Okay, so in options contract, we can say required the premium payment. Okay, so two parties do the options contract. One is paying the premium, okay, and one is receive the premium. But who is the pay of the premium has the options to for uh, we can say follow that we can say he is has the right but not the obligations to uh, buy or sell the uh, we can say goods or services or any of the entities in the contract, okay, or we can say at the international level it may be a foreign exchange rate, it may be a currency, okay. So it provides the downside, but the other party has the party who is receives the premium that has the obligations to follow the contract. Okay, and that party cannot say that I will not follow the contract because they already we can say takes the premium from the other party. Now they has to follow the contract. Okay, so the forex options provides the downside protections, all the allows the upside potential. So these are the benefits are we can say from the options contract. Okay, so the same likewise, the swaps contracts, the forex swaps is identical to what is the swaps contract. The swap contract is actually the purchase and sale of the identical amounts of currency for the different value dates. Okay, we know that swap contract is nothing but the taking advantage of the price difference on the two different dates. That means we are purchasing the currency uh, at one time and sell the same currency when the prices of that currency gets decreases. That is nothing but the swaps contract. What we see, that is what the speculator does. Okay, speculator takes the advantages from the price difference for the two different nations at two different times. Okay, so in the same case that we are doing the swaps contract, swap contract, what do we do? We buy the currency from some of the suppliers at to one rate, and we sell the same currency to the other we can say buyer on the with the two different dates. So for both with the both parties, we do contracts and we take the advantage. Okay, so how the exchange rate we can say decided so the exchange rate quotation and the arbitrage. Okay, so what is mean by arbitrage that we are going to understand in the upcoming sessions. Okay, so now first we understand what is the exchange rate quotation. Okay, how the currencies are quoted and price. We can say is the fundamental. We can say is in operating the foreign exchange market. Okay, so it is the fundamental thing that is the exchange rate. So this is one of the example given to us, that is the exchange rate quotation that we are going to convert the euros into the US dollar. Okay, so the here is we can say the base currency is euros and the quote currency, in which currency we are going to quote the euros, we are going to quote the euros to the dollar. So base currency is euro, then the quote currency is the US dollar, and the we can say the exchange rate is the we can say the €1 is equal to $1.0825. Okay, so what is the bid and ask price? If you know uh, the bid price and the ask price. So bid price is the we can say a maximum price on which the buyer is ready to buy the any goods and services. Same likewise in we can say in the exchange rate in the foreign exchange market. So bid price is the maximum value on the value on which the buyers agrees to buy the currency. So ask price is the price we can say it is the minimum price on which the seller agrees to sell the goods and services. In case of the foreign exchange, so it is the minimum we can say price on which the seller of the currencies agrees to sell the currency. That is the ask price. Yeah, okay. If we can say the difference between bid and ask is low, it's okay. So we can say the happening of the trade, that is the possibility of the trade is higher. That is, we can say if the spread is narrower, that indicates the greater liquidity and the lower transaction cost. That means the transaction happens very smoothly. But if the bid price is higher, in that case, what happened? We can say that transactions have the higher transaction cost. So this is how we can say the difference between bid and ask, that is the buyer's expectations and the seller expectations, that we called as the spread. Okay, here the spread is 0.00005. Okay, so this is how we convert and we quote the currencies, that is the one currency into the other currency. Okay. And the arbitrage is the person who takes the advantage between the two different markets. That is, for example, if I take uh, here is, we can say there is the season of Ganpati is going on. If I say the murtis of Ganpati is the cheaper in Pune, and you can say is costlier in Mumbai. What if I'm the arbitrage? I know the market conditions. What I do, I buy the Ganpati murtis from Pune market and I sell the same murtis in the Mumbai market. So I take the advantage of the price difference. So arbitrage is the person who take the advantage of that price difference. Okay. So there we can say the arbitrage is who's exploiting the price differentiation for the same currency pair across the different locations or the dealers. Okay, the same case will be happened in case of the foreign exchange rate. Okay, in some of the time, what will happen? That is the exchange rate in one country is different and the exchange rate is another country is different. So the arbitrage who takes the advantage of these price differentiations and take the advantage. Okay, so the person who is the, we can say the arbitrage. Okay. Uh, okay, so we'll have the very less time. If you have any questions, you can ask, or then we will sum up the sessions. Okay, so it's already 5, I think 7:58. If you have any questions, you can ask, or otherwise we'll end the session. Okay, if you don't have any questions, now you can we can say leave the sessions and join the other sessions. Okay, thank you guys.